Most traders hear the phrase, "the trend is your friend," early in their journey, but almost none of them truly understand it. They repeat it like a slogan, they write it in notebooks, they put it on wallpapers. Yet, the moment price looks too high or too low, they betray it. This chapter is not about memorizing the phrase. It is about understanding why the trend exists, who creates it, and why fighting it is a slow financial suicide. The market does not trend because of indicators. It does not trend because of news headlines. It trends because large institutions need direction to efficiently execute size. Banks, hedge funds, and algorithmic execution models cannot operate in chaos. They require sustained movement to accumulate, distribute, and rebalance positions without exposing their intent. That sustained movement is what retail traders call a trend. A trend is not a line on your chart. A trend is a delivery mechanism. When institutions want to accumulate long positions, they do not buy randomly. They engineer conditions where price can move higher over time, allowing them to enter on pullbacks, rebalance risk, and continue building exposure. The same logic applies when they want to distribute or short. This is why trends persist far longer than logic would suggest. Not because price is overbought or oversold, but because the objective has not yet been fulfilled. Retail traders lose money because they assume the market exists to offer them fair prices. It does not. The market exists to facilitate large transactions efficiently. If you understand this, the trend stops being mysterious. It becomes obvious. Let us deal with the hard truth early. You are not smarter than the trend. Every trader who tries to fade a strong trend believes they have found an exception. They believe they are early. They believe they see something others do not. In reality, they are reacting emotionally to extended price. They feel discomfort buying high or selling low, so they justify counter-trend positions with stories. Indicators help them tell those stories. Divergence, RSI extremes, Fibonacci levels pulled from irrelevant swings. None of it changes the core fact. They are trading against institutional intent. A trend represents agreement between time frames, agreement between liquidity flows, agreement between accumulation and expansion phases. When you trade with the trend, you are not predicting, you are aligning. That distinction matters. Prediction requires ego. Alignment requires humility. The market does not reward ego. One of the most damaging habits retail traders develop is the obsession with tops and bottoms. They want to be right first, not right consistently. Catching a reversal feels intelligent. Riding a trend feels boring, but boring is profitable. Professionals are not in this business to impress themselves. They are here to extract money repeatedly with minimal emotional exposure. Think about how trends actually move. They do not move in straight lines. They expand, retrace, consolidate, and then expand again. These pullbacks are not reversals. They are opportunities engineered to attract liquidity. When price retraces in an uptrend, it invites sellers. Those sellers provide buy-side liquidity for institutions to add long positions. Every failed sell in an uptrend strengthens the trend itself. This is why counter-trend traders feel constantly almost right. Price reacts, it pulls back, it hesitates, but it does not reverse. They confuse reaction with reversal. Institutions understand the difference. The trend remains intact until market structure shifts, not until price feels uncomfortable. A higher high followed by a higher low is not random. It is confirmation that demand continues to overwhelm supply at progressively higher prices. Until that behavior changes on the relevant time frame, fading the move is nothing more than gambling disguised as analysis. Now let us talk about time frames, because this is where most traders sabotage themselves. A trend only exists relative to a time frame. Price can be bullish on the daily chart and bearish on the 5-minute chart.